Welcome to our review of Q2 and the mid-year outlook for the rest of 2024. So let's get into it. U.S. stocks made an impressive comeback after a brief slump in April, proving the, sell in May, go away skeptics wrong. The rebound was really fueled by another round of earnings surprises from a lot of the mega cap tech giants in a series of Goldilocks economics reports, which really have indicated optimal moderating growth. Emerging markets have underperformed compared to a lot of the developed markets. However, a rebound in AI and semiconductor stocks in both Taiwan and South Korea provided some much needed support for a lot of those EM stocks with that exposure. Interest rate speculation, on the other hand, in the US continued to cast a big shadow over bonds. But a pretty modest shift in the Fed's hawkish stance, with Jerome Powell, who's the head of the Federal Reserve, pushing back against future rate hike rumors, offered a little bit of relief. And this led to lower yields across really the entire fixed income spectrum, with longer duration and higher quality bonds performing the best. So over the last quarter, we made some tweaks across all of our client portfolios. Now, as usual, none of this is intended as investment advice. And if you are a client, your particular strategy is probably going to vary based on a lot of the personalization things that we do. That said, as the famous saying goes, when the facts change, I change my mind. However, for the most part, the facts really haven't changed since the update last quarter, and neither has my mind or our forecasts. We still prefer stocks over bonds, the US over international markets, mega cap over small cap, and growth over value. Now, despite various challenges like interest rate volatility, hawkish Fed talk, future election uncertainties, conflicts in the Middle East, stocks, particularly mega cap tech and growth companies, have continued to perform exceptionally well. Now, we believe that the ongoing AI renaissance will significantly boost a lot of the CapEx spending and economic productivity within companies, which will strengthen the U.S. as an economy, as a global growth engine in the economy. Now, while inflation has been stubborn lately, it's largely due to a lot of noisy data and seasonal adjustments. Now, I would expect these sticky inflation prints to weaken in the future, possibly surprising to the downside by either late summer or early fall. And that scenario could benefit trades like long duration, long EM stocks. So we're starting to explore some of those opportunities. Now, if our forecast doesn't pan out, we may need to adjust our strategy, taking to heart the John Maynard Keynes wisdom. But for now, our outlook remains steady. So with it being an election year, I wanted to include just some brief commentary to give some context as to how specifically this year compares so far. So really, we're having a fantastic year for stocks, especially, considering an election year. So we've just hit the fourth best start since 1926, with stocks up a little over 11% from January to May. Now, historically, when stocks start strong in election years, they often keep going. Take 1928, for example. After about a 15% rise in the first 5 months, stocks soared another 25% in the next 7 months. And in 1976, a 13% gain was followed by an extra 10% through the remainder of the year. And while performance doesn't guarantee future results, this strong start, I would say, is definitely encouraging. Now, we also have some great news that the U.S. economy is proving to be quite resilient. Now, even though growth has slowed a bit, it's still on solid ground. The big, less rate-sensitive companies still have been driving the bulk of the S&P 500 returns. And as you can see on the left side of the chart here, quarterly U.S. real GDP growth has remained positive. Now, second, earnings growth on the right side is projected to stay strong and even broaden out. Now, for 2023, S&P 500 earnings grew 2.4%, and it's expected to shoot up to 10.7% for 2024, again with these growth stocks really leading the way. So shifting gears here a little bit, I want to talk a little bit, as we do in every video, about inflation and interest rates, especially over the last couple of years here. So the Fed still taking a cautious approach with their rate policy. There's really two things here. First, progress on inflation has been slow. The core CPI readings have been gradually decreased from 5% in June last year to 3.4% in May of this year. And while this is progress, it's still above the 2% target that we're trying to get to. Second, the Fed has revised its interest rate expectations. They now project end-of-year rates to be higher than previously thought. For 2024, they expect rates to be around 5.1%, up from the earlier projections of 4.6%. And for 2025, they've revised it from 4.1 to 3.9%. This really suggests that while we might see some rate cuts, rates will likely remain high and in restrictive territory for some time. Now, more commentary is coming out in the next couple of weeks from Powell, so stay tuned. So in closing, I want to break down really the three key takeaways and themes regarding our current economic outlook. Number one, high interest rates are creating winners and losers. High interest rates have really opened up opportunities for income seekers. You're able to get paid more on your cash now. However, they've also made it tougher to borrow for smaller companies. Number two, doubling down on quality and growth stocks. Companies with strong balance sheets and consistent earnings are better positioned to thrive even with high rates and slower growth. Plus, companies leveraging AI could see even more growth potential. And lastly, number three, positive economic outlook suggests an overweight to risk assets. So we're seeing more upside potential in stocks compared to bonds. And again, this potential outlook makes us comfortable taking on credit risk within bonds. So thanks for tuning in. If you are a client, you've already received your personalized performance recap, net worth progress report from last quarter, but please don't hesitate to reach out if you have any questions. As always, stay the course, stay on point. Take care.